Ladies and gentlemen, good day and welcome to the Burger King India Limited Q1 FY22 results conference call, hosted by Edelweiss Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nihal Mahesh Jham from Edelweiss Securities Limited. Thank you, and over to you, sir.
Yes, thank you, Faizan. Good afternoon and welcome to the Burger King India Q1 FY22 results call. From the management today we have Mr. Rajeev Varman, CEO and Whole-Time Director, Mr. Sumit Zaveri, Chief Financial Officer, Mr. Kapil Grover, Chief Marketing Officer, and Mr. Prashant Desai, Head of Strategy and Investor Relations. I'll now hand over the call to Mr. Prashant Desai for his opening remarks. Over to you, Prashant.
Thanks, Nihal. Welcome everyone to this Q1 FY22 conference call of Burger King. Trust all your family and friends are safe and wishing you all a very happy 75th Independence Day. This is how we will be taking the call forward today. I will pass on the call to Raj for his opening remarks, post which very quickly I will take you through the operating highlights of the business. Some of you would have seen the presentation. Then I will hand it over to my colleague Sumit to take you through the financial highlights, and Sumit will then hand it over to Kapil for the highlights on marketing, cafe, etc. Then I'll quickly take you through the guidance, and then we'll open up the call for questions. So what I will do is I'll hand it over to Raj for his opening remarks. Raj.
Thank you, Prashant. Thank you, and same as Prashant said, I hope everyone is safe and staying masked. And please get your vaccinations. We are doing that on the company side as well. We have got 99, close to 100% of our people vaccinated on the first vaccine, and the second vaccine has also started. Those that are coming up for due for the second jab, we are proceeding with that as well. We expect that the entire organization should be 90+% vaccinated sometime early October. So that's critical for us, and we stay focused on making sure that we are getting there. Now we have had a eventful, I would say, the first quarter with the second wave coming in, and leaving a lot of restaurants and a lot of malls closed for a time period. The good news is, as a company, we are getting out of it, and so is the general, economy as well coming out of it. So today, if you look at our recoveries, while the first quarter was only at about 67% recovery, today, if you look at July and August, the recovery has been north of 90%. In fact, the recovery this August, which is just a month-to-date number, is north of 95%. So a strong recovery back after the second wave. We feel good about that, and we were very strong, staying aligned, so that once the recovery comes in place, the ops team, supply chain team is in place to move it forward. Now, if you look at the quarter that is, and Prashant will go into depths of the performance in a minute, but I think one of the things that we have done as a company that I'm proud of is we stayed very still and very focused on our P&L line items. And if you will see that whether it's margins and other line items on the P&L, I think the team has done a phenomenal job in this quarter to keep everything in control and do a good job with that. So with that said, let me just quickly go through what we are as a company. Our pillars still continue to be the same. If you look at our growth pillar, we are still focused on going to our 700 restaurants December 2026. That goal is very real. In fact, this last quarter, in spite of the second wave, Abhishek Gupta and his team have gone forward and opened 5 new restaurants. They've not only opened 5 new restaurants, but they've also put 13 restaurants into construction. They've got a pipeline of another 21 restaurants. So they're building a healthy, finish to this year. So that's the way we're moving forward on that. Now, our goal will remain to get as close as possible to 320 restaurants that we'll try to open by the end of this fiscal year. With that said, let me just go quickly over to the other pillar that we speak about all the time, which is the BK app. Now, the last time we were on the phone with you, we spoke about all the different things that we were doing with the BK app in terms of, the technology piece of it, by removing bugs, by, bringing the loyalty interface, the rider journey, the entire technology effort was put in place. Now, what we have done in this during this first quarter is we have also done that in the operations area. For example, we are moving forward with e-bikes for all deliveries done by Burger King themselves, not by our aggregators, but our own deliveries will be done through bikes, using e-bikes, both from environmental and sustainability point of view, but also from very good, strong economics point of view. So that makes a lot of sense for us to move that forward. So that's one of the things that we have launched. Kapil will share with you in a few minutes about the massive downloads that have happened just in the initial phase of our BK app download. Our goal again, remains to take 1/3 of the business that we are doing and put it on our app in the near future. So that remains a strong goal, and we'll continue working on that. Kapil will share with you some details on the BK app. The next pillar we shared with you last time was the BK Cafe. And not only a lot of people outside of the company were excited about this, but the entire company is extremely excited about it. And I just want to share with you today that we will be pulling up some timelines. We will see the cafes in Q3 versus Q4. So we are pulling that timeline a little ahead, and you will see those coming through in the next quarter as we open some cafes around the country. Now, I wanted to make sure that people understand why we are doing this and what BK Cafe means as a business. See, one is it strengthens the breakfast day part, bringing more and more people in because they have this not only the breakfast menu that Burger King is so proud of, but also the cafe environment. Additionally, it also caters to those day parts between lunch and dinner. So it's a very strong business that complements our existing business, and that's why we are so excited about it. So we will share a little more details. Kapil will talk about our progress on it, but from the look of it, as we have finalized the menu, we have got the machines, the layouts, the first 75 to 100 restaurants have already been put on a map. The drawings have been completed. The equipment is in the process of being placed. The orders are being placed. So we are in high mode in terms of moving forward with the cafe. And the last piece, which is the value piece, which I think as a brand you would appreciate that Burger King in India is the leader in value, right? So when we did the Value 1.0, and Kapil is sitting right next to me here, and he'll talk about it. But when he rolled out Value 1.0 in that 2017-18 time frame, we were able to move traffic and sales up by 29%, and that was the effort in that year, wherein we launched 1.0, Value 1.0, and we got those kind of stuff. Now, 2.0 is a fantastic menu. It is not only something we think will do very well, as we have just put in almost 1,000 GRPs this last month, between July 15th and August 15th. We have done a phenomenal job, buying some very good television, great ads out there that you might have already seen. But I encourage you all to go to our restaurants and try the menu. The menu is a stunning menu. It actually has a very good gross margin as well. There's two pieces of the menu. One is at 50 rupees, which is on television, which is about 6 items that are good variety between wraps and a new item called Volcano and burger. down to 70 rupees upgrade menu, which is on the non-veg side. So you'll see a very balanced menu when you go into our restaurants, and Kapil will share how we're doing with that and how we're moving forward with that. So those are my early remarks. I will obviously be throughout the entire meeting, and we'll take your questions towards the end. So with that said, I will turn it over back to Prashant, so Prashant can kind of walk you through the rest of the presentation. Over to you, Prashant.
Thanks, Raj. So guys, Raj having given the executive summary, we'll move quickly to slide 8, which talks about our pan-India ADS recovery. One context that we want to build for everyone, when we were thinking which is the best way to showcase our business to our investors, what we realized is last year being a very exceptional year because of COVID, if we would have probably tried to represent the business on a same-store growth perspective, the numbers would have looked out of whack. And given that when we came to you last time, we said that this year our guidance is that the team will endeavor to achieve the ADS that we did on a portfolio basis in FY20. So we are keeping that as our goalpost in terms of what we want to achieve in the current year. And what we have done for everybody's understanding is all the numbers now we are trying to map, keeping that as a framework. So if you come to slide 8, our baseline FY20 ADS, we ended at 1,10,000 rupees, and we are representing our recovery. So our recovery, as Raj mentioned, in July was about 92, year to date, month to date, August is about 95%. So that's 95% of 1,10,000 is where we have recovered. If you go to slide 9, because we are a pan-India business, we are showcasing to you the recovery done regional wise. I know a lot of you will have questions in terms of the discrepancy in the regional recovery, but this is nothing but purely base effect, so there's not much to read into this. But the West has recovered large because the base effect was lower for West. Coming to slide 10, as you are seeing, then this is where I will probably draw your attention, and we are also now getting surprised at this recovery trend. If you will see the delivery recovery, which is currently standing at 173%, was about 170 just 2 months back. When it was 170 at 2 months back, our dine-in recovery was just 16%. But as we are ending July, the delivery recovery is still 173, where the dine-in has recovered from 16 to almost 60%. So currently we are seeing a significant strength in delivery recovery. As dine-in is recovering, the delivery has still not given up, and that's a very healthy thing that we are currently noticing. I will now give it to Sumit to take you quickly through our financial performance.
Thank you, Prashant. I won't take too much time because Prashant has covered the key parameters and Raj has also covered the broad parameters on the business side. As far as revenue is concerned, we did a revenue of 149 crores as compared to 196 crores in the previous quarter and 38 crores the year before. Obviously, those are not comparable because we were impacted by COVID. The key highlight here is that we continue to perform strongly as far as gross margins are concerned. We were at 65.6. We continue to be over 65% as far as the current quarter is concerned. And going back, when we talk about guidance, we continue to believe that we should be able to achieve and surpass the guidance as far as gross profit is concerned. And then our restaurant EBITDA. Now we are talking about, and that this is what we will continue to do going forward as well, which is that we will continue to report our numbers on the post-Ind AS 116 basis, so that at least now the comparability between quarters and previous years continue to remain, and it's easier to kind of compare to the financial results that we publish to larger markets. So our restaurant EBITDA on a post-Ind AS basis stands at 11%, and at a company level, it stands at 1%. So with that, I would hand it over to Kapil to take through the marketing updates that we have for the quarter.
Thanks, Sumit, and a very good afternoon to everyone on the call. While it was a tough quarter given the resurgence of the second wave and lockdowns, we at Burger King stayed focused on our long-term strategy to strengthen the brand and the business. Now, last call, I spoke about the barbell strategy. On the one end of that barbell is the signature product, the Whopper, and its limited time variants. And on the other end is the value menu, which helps drive traffic, especially in dine-in restaurants. Now, I had shared with you that we have soft launched our stunner menu, rupee 50 stunner menu. That's on slide number 13. Through the last quarter, as Raj mentioned, we've scaled up the menu and taken it on national media in early July, as the dining restrictions opened up and eased off in many parts of the country. This was a multimedia campaign with impact presence on top television shows in the country and an equally strong digital and social leg to drive awareness of the new menu. The campaign has helped us gain momentum on dine-in recoveries, as you saw in the previous slides. Now, we've got fantastic customer feedback on our new menu, and we stay committed to our long-term strategy to offer our customers unbeatable taste, highest quality products, and variety at affordable prices. With that, I'll move to slide number 14, which is the other end of the barbell menu, which is the Whopper portfolio. Now, Whopper is not just about high quality or a one-of-a-kind product, but we look at it as a sub-brand, more like an attitude that participates in cultural conversations and helps strengthen the brand Burger King. Now, we continue to grow the Whopper franchise. Today, if I share a number with you, almost 1 in every 3 customers order a Whopper. Now, that's a big start for us on the Whopper portfolio. We continue to launch a new limited time variant every 60 days. So if you were to visit a Burger King store today, you will try the Masala Whopper, which is inspired by Indian palate and Indian taste. That brings me to slide number 15. As I mentioned, Whopper is not just a product, it's an attitude. Now, I'm happy to share that we won 2 awards in the last quarter from industry forums on our Valentine's Day program, which is about #DateTheWhopper, where we had the matchmaking sensation Seema Taparia encourage millennials to break up with mediocrity in their lives and choose the juicier, spicier Whopper. And we'll continue to work on this brand building exercise. Now, I am on slide number 16 now. We mentioned to you last time about the 2 key strategic initiatives, which is the BK app and the BK Cafe. Now, I'd love to share progress on both of these. Let me start with BK app. Now, as Raj mentioned, we started work on the BK app effectively last quarter and started to scale that up. Now, while we continue to work very closely with our delivery partners on category expansion tasks and to build delivery sales, we also continue to build on our own platform. In this quarter, we have seen 130% quarter-on-quarter growth on the BK app sales and now over 1 million app downloads. We continue to invest in technology and resourcing to make our app faster and more efficient, and recently rolled out version 6.0 with a host of new improvements in the ordering experience. Our app size is now under 20 MB, and we'll continue to improve that. In addition to the app, we continue to improve customer experience through packaging, rider tracking, and optimal store mapping. Now, as a responsible brand, one of the important experiments that we started recently doing in our select stores in Hyderabad and Delhi NCR is the use of electric bikes for our own riders. Now, as Raj mentioned, this is an environmentally friendly and an efficient means of delivery. It's a pilot, and as we learn from it, we will start to expand it to other markets in coming times. That brings me to slide number 17 and the second strategic initiative from a top line and profitability perspective, the BK Cafe. Now, we have started BK Cafe with the same principles as we did Burger King 7 years ago, that our food will be of the best quality, locally sourced coffee from the best in class. Right. The first step was to put in place the right talent and coffee expertise. We have now one of India's 4 Q graders and an international barista champion, Felix Daniel, who's joined on the BK team. He's working on the coffee blend. And the team is now designing our cafe menu, building the best-in-class processes for training our teams to execute a fantastic cup of coffee. So we are well on track to launch the cafe concept in quarter 3, quarter 4 of this financial year. In summary, we stay focused on the 4 key pillars: value strategy led by the stunner menu to drive traffic, strengthening the Whopper franchise and thereby strengthening the brand Burger King, building the Burger King app platform, and introducing BK Cafe as an additional occasion, thereby driving top line and margins for the business. Now, before I close this section, I would just like to reiterate on a very important topic that Raj also spoke about, and which is about the employee awareness program around COVID vaccination. As Raj mentioned, we have achieved almost 100% first dose and eligible second dose vaccination for our field staff, and our teams continue to work diligently to make sure that all our eligible staff take their second dose to ensure their safety and our customers' peace of mind. At this point, I will hand over to Prashant to talk us through the future outlook.
Thanks, Kapil. Guys, when it comes to guidance, our guidance remains the same. There's no big change over there. As we had mentioned, we are planning to open close to about 320. We should end this year with. And next year, take this to about, by FY24, take this to 470. As we said, our endeavor this year is to, come back to the FY20 ADS of 110,000. And next year onwards, we are guiding a 5 to 7% SSG. Our gross profit, our gross margin guidance remains the same. This year, we are targeting 66% and taking it to 68% by FY24, which is without the cafes. With this, guys, we'll open up the floor for Q&A. Would request Edelweiss to open the floor.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good afternoon. My first question is on the cafe format that you're planning to launch within your stores. So any kind of modeling you have done or any kind of estimate or expectation you have as to how much incremental sales can you get per store on this base from this initiative?
Right. So thank you for your question. This is Raj. I'll take this one, and if Kapil wants to add anything else. Look here, as I was saying, we have just pulled up to Q3, the rollout from Q4. And what we are doing is we will be launching some seed cafes in Q3. And we will be then, putting in our menu and the coffees and so forth to learn how this menu does and how we should better it before we do the 270 restaurants plus the restaurants that we will be building during this period. Now, if you look at the industry wise, what we have learned around the industry is that this contributes about anywhere between 15 to 20% of sales, and this not only strengthens the breakfast. If you do a good job, strengthens the breakfast, but it also strengthens the day part between lunch and dinner. So you have these snacking day parts which get very strong with the launch of cafe. So the potential of what this will do will be something that we will discover alongside yourself. But I think it's very promising from what we have seen so far with the industry rollout.
And so, but it's too early to kind of guide you in terms of the numbers and what our internal expectation is. Just allow us to run this business for 3-6 months, and post that we'll come back. And as you have seen, we guide on a lot of other things. We'll also guide you guys on cafes once we have run and operated this for 6 months.
Sure. And you have 470 targeted total stores in FY24. So out of those 470, how many do you think will be having the cafe format within them?
So all the restaurants that we are going to be opening moving forward will all have cafes. And when we reflect back on the 272 restaurants that are open as of today, as we speak, we will be then moving forward over the next few quarters to get those all to have a cafe. Some of these you would appreciate will have much more versions of the cafe, and some of them will have a full-fledged, cafe. So we'll have a format that's A, B, and C, and you will see versions of that across. But the intention is at some point to have 100% of the portfolio with cafe offerings.
Sure. My second question is basically as per your guidance, the ADS in FY23 should be about 5 to 7% higher than FY20. Leaving aside the fact that this seems to be a very conservative number, But if I go along with this number with this kind of ADS, what kind of restaurant EBITDA margins can you generate? And if you can break that number up into how much is coming from operating leverage, that 5 to 7% extra versus FY20, how much is that adding to the margins? And how much would come from your own cost saving initiatives? So thereby I can compare how much, let's say, EBITDA margin expansion can come through from FY20 to 23, and what are the drivers? How much is operating leverage? How much is cost saving, and how much is gross margin? Gross margin you have anyways given, so the remaining two will help us.
So Percy, as a matter of principle, we only guide on gross margins. We don't guide on ROMs, and we don't guide on EBITDA margins. But broadly speaking, if you would have heard the commentary that we've given right from the time that we went public to the couple of conference calls that we've done, principally there are three large pillars which drive operating leverage in our business. One, as you know, is gross margin, which we have guided. Second is based on the revenue throughput that we do. We believe there will be a fair amount of operating leverage coming from the rental. As you know, when we ended March 20, our rent to revenue was about 15%. We mentioned this in the previous calls that if you look at the 270 restaurants that we have, we opened almost 50% of these restaurants in FY19 and FY20. So that 50% of the portfolio that we opened in FY19 and 20 was roughly in that 12 to 13% rent to revenue ratios. As we move forward and these restaurants start contributing, you will see operating leverage also kicking in from a rental perspective. And the third piece that Raj has extensively spoken right through our roadshow is that we run this company very frugally. If you look at our corporate cost, probably about 60 odd crores, you can say, for the current year. And we've told, and we've not guided, but our internal view is this won't go up more than 10% every year. And if you put all this in perspective, you will see there will be a massive improvement both at the ROM level and at the company EBITDA level, but we don't guide on that person.
Here's my confusion, Prashant. While you say that a lot of your stores are very young and they will ramp up and that will give operating leverage, but your ADS growing only 5 to 7% over 3 years. So here is where I find a disconnect between these two statements.
No, your point is fair, Percy. When we talk here with the markets, we talk on a portfolio level. We don't talk on an individual store levels. So as a portfolio level, because of the massive uncertainty that we've just come through, we mentioned this in the last call that we are currently guiding that we are first wanting to recover back to where we were in FY20. Basis where we today see the recovery, we are comfortable about a 5 to 7% SSSG. That does not mean that if the recovery is better, if more people keep coming, if we maintain this trajectory of growth, we will not come and revisit the guidance. So I am purely coming from that perspective. It's better to kind of share with you what we honestly feel rather than just guide you for the sake of guidance, Percy.
Sure. Understood. Thanks. That's all from me. Thanks and all the best.
Thanks, Percy.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Vicky Punjabi from GM Financial. Please go ahead.
Hi, sir. Thanks for taking my question. I mean, a little bit more on this SSG guidance of 5 to 7% for next year. Now, sir, if I look at your first half, I think your first quarter has been something like a 67% ADS. I think the next quarter would be still below 100. We're talking about a flattish kind of ADS for the full year versus an FY20 level, which kind of, as per my workings tells me that, second half would be something like mid-teens kind of an growth in your ADS. Now, even if you could just maintain your second half run rate, I think that 5 to 7% looks very easily achievable in the next year. Are we being overly conservative on this SSG front for the next year, or am I getting my calculation somewhere wrong?
I know, Vicky, and believe me, it's not that it gives me, a lot of fun to guide you lower and then over deliver. You have to understand we run the business, running restaurants. We know what's happening on the ground. Just be patient with us for a quarter. As I said, what we've learned is better to go with what we feel is right And believe me, after one quarter, what you say turns out to be true, we will come and up the guidance. So we have no hesitation in doing that. But currently, from where we are sitting, we currently want you guys to build your model, keeping a 5 to 7% SSSG in mind, and we'll revisit this year.
Sure. Second, sir, just I needed understanding on the cost front. Now, if I look at this quarter versus say March quarter of 4Q last year, and this is purely on the other expenses. We had a sales decline of 24%, but the other expenses decline was something like 8%. I can understand, staff costs being much lower, but staff costs seeing a very, very muted decline. But the other expenses, I thought there are quite a few variable line items sitting out there. Any reasons why this part of the line item didn't show as good a variability this time around? I mean, it's in a way, if I look at the June quarter sales, it's like 150 crore versus say a December quarter sales, which was 163 crores, and other expenses still look, set at 865 crore versus the December quarter at 57 crores. So it still looks much higher than December quarter, just 8% down versus March quarter, which is, in a quarter where the sales actually declined by around 25%, 24%.
Yeah, I'll let Sumit take that.
Vicky, I'll just ask that question. One is that, those numbers per se are not comparable. The reason is that when you compare it to last year of March 21, you realize that had substantial reduction in cost on account of rental savings, which kind of got adjusted as part of other expenses and other income per se. Similarly, when you do a comparison to quarter one of last year, similarly, the numbers were quarter one of last year, really, there were no rent savings there. And if you really compare to that, the rent reductions that we've got in June is is substantially lower. Like, I'm talking about around 6 crores versus a number of around 45 odd crores for the full year. So that is really the big difference when you try to do another expense comparison between the two periods, Vicky.
Okay, so beyond that, you're saying that most of the costs were variable, particularly of these rental adjustments, the saving adjustments were there. That's the reason which is, we are not seeing the same kind of variability.
Absolutely.
So if you simply break it down, Vicky, 65% is my gross margin, and let's say this quarter I reported a 10% ROM. So there's a 55% expenditure between gross margin and ROM. And where Sumit is coming from, essentially some part of this, a large part of this is variable in nature. So when you actually compare a quarter compared to this quarter when he's coming in, these are not typically comparable because of the whole this COVID situation where restaurants were operating at very different levels, so on and so forth.
Sure, sir. Okay. That's it from my side. Thanks a lot for your answers.
Thanks, Vicky.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Arvind Datta, individual investor. Please go ahead.
Yeah, hi, good afternoon to you. Can you hear me?
Yes, we can, Arvind.
Yeah, so my question is regarding the finance cost of 167 million for the quarter, which was 163 million for the last quarter, March quarter. But as per your IPO, the schedule of the funds usage, it said that 1649 million was paid back. So why these finance costs and what do they relate to basically?
Sure. Arvind, hi, this is Sumit here, and I'll take that question. So one is that as far as debt is concerned, you are absolutely right, Arvind. We have paid off the debt out of IPO proceeds. So as we speak today, we don't have any debt on our balance sheet. Right. This finance cost is only arising because of the way the lease rentals or the lease accounting is done, where the entire future rentals gets that's capitalized by way of net present value. And then as we kind of amortize that cost, interest cost inherent sitting in that lease cost comes as part of finance cost. So this is purely coming out of lease accounting. There are no interest outflows on account of borrowings that are sitting on our P&L.
Okay, thank you. That was the question.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Devanshul from Emkay Global Financial Services. Please go ahead.
Yeah, hi. Thanks for taking my question. So just wanted to understand the space allocation for cafes within our existing stores. So are we going to reduce some of the dining space to make space for cafes? And also, if possible, if you can indicate the additional capex that would be required for this segment.
So we have basically two groups of restaurants, right? First is those that have already been built, and then those that we're going to build. So we've got 270 out of 700 restaurants that we're going to build, right? So the future restaurants, the plans will be done with the cafes inside, incorporated into it, right? So that's moving forward. Now, if you look backwards, we are, like I was saying earlier on, we have A, B, C kind of platforms of cafes where A would be a substantially larger cafe which would go in a larger kind of restaurant. And then the smaller ones, the B and C, would be the ones that would, for example, go in a food court in a mall, wherein we will just extend the counter and put in a cafe there. So you will see different versions of it. We will start sharing, costs and so forth after we put a handful of these moving forward. Like I said, Q3 and 4 is going to be our rollout period for the first few, and we will start guiding and sharing those numbers as we move forward.
Devanshul, generally, you would have seen the experience of cafe. Incrementally, the capex is very minuscule compared to the capex that we do for the full-fledged Burger King restaurant. So just keep that in mind. It won't be a significant incremental capex.
Sure, thanks. So just to confirm, as in you are indicating that we will be going for relatively higher store sizes for the new stores?
We have always been very prudent in the way we have built our restaurants. If you reflect on the sizes we have looked at, we generally look anywhere between 1,800 and 2,400. So what we're going to do is we're going to stay more closer to the 100 versus the 1,800. But the guidance of doing those restaurants will still be the same. Where we're going to put a C cafe, we would still be okay with a 22,000 square feet kind of restaurant. Where we're going to put a larger, will be more skewed towards the 2,400.
Sure, that's helpful. Thanks.
Thanks, Devanshul.
Thank you. The next question is from the line of Hiren Ved from Alchemy Capital. Please go ahead.
Hi, thanks for taking my question. I want to know how many of your existing stores are in malls, and after the restrictions were lifted in Maharashtra, is everything operational now, and are you seeing footfalls already starting to come in?
So Hiren, you are right. 55% of our stores are currently in malls. But the malls have opened up, but they are still not kind of completely opened up. I was yesterday at a mall where if you are not double jabbed, they are not allowing you. So the fine tuning is still going on. You also have to, Hiren, keep in mind that we are all looking forward to the release of Bell Bottom coming up on 19th August. Let's see if that happens. So currently, a lot of the dine-in recovery that you are seeing is not purely mall-led. It's still high street-led. Takeaways is doing well. And which is what I was essentially telling others when they kind of kept asking me to up the guidance for next year. We are all looking forward to these malls opening full-fledged multiplexes starting. A lot of our food court restaurants are next to the exits of multiplexes, and therefore if multiplexes open up, it will result in a much larger business. So from that perspective, yes, malls have opened up, but have they significantly contributed to the dine-in recovery so far? Answer to that is no.
Okay. Thanks a lot.
Pleasure.
Thank you. The next question is from the line of Rashi Vora from Prabhudas Lilladher. Please go ahead.
Hello, good afternoon, sir. Thank you for the opportunity. I just have a couple of questions. Can you hear me, sir?
Yeah, we can, Rashi.
Okay. Sir, is it possible for you all to share the pre-Ind AS restaurant EBITDA number and the company EBITDA number pre-Ind AS as it was given in 4Q FY22? It would be really helpful if you could share the same this time.
So Rashi, as a matter of policy, we have decided now to go ahead with the post-Ind AS numbers. So that will not be possible from our side.
Okay. Okay, sir. And sir, the SSSG number this time, somehow I haven't, so what will it be this time, sir?
It will be a very high number, Rashi, and which is why we chose not to put this.
Okay.
Because it's misleading to that extent, right? We are all used to a 5-7% SSSG. And if I, for example, were to put a 150-160% SSSG, it just kind of gives. But if you want that number separately, please reach out to me. I will share that number with you. But the way we are looking at this business is if I am kind of guiding you guys that we will do on a portfolio basis 110, where are we today? And that is what we will kind of come and report to you. And hopefully we will have a normalized FY22 starting today, which means that when we come back to you guys next year, we will have a SSSG number reporting as usual. Because of the unfortunate last year, the SSSG kind of loses its significance from reporting perspective. But if you are interested, just drop an email to me and I will share that number with you.
Surely, sir. That was very thankful, sir. That's all from me, sir.
Thank you.
Thank you. The next question is from the line of Ankita Baheti from Newquest Capital Partners. Please go ahead.
Hi, thank you for taking my question. My question is around your slide number, the one where you're talking about the delivery versus dine-in mix. You know, it seems that delivery overall has retained like essentially the lion's share of your overall sales mix at a 60-40% kind of share in comparison to even 40-60 at the end of Q4 FY21. So I have a couple of questions. The first one being, do you see this as an overall, paradigm shift in the underlying industry where you think that delivery and takeaway might continue to contribute to the lion's share of revenue going forward, as a habit change? The impact and what is the impact that at a company level you think you might need, if at all you think you might need to make any structural changes around the way that you approach your business? The second is also if you could throw some light into how this recovery has happened. Is it essentially that the number of transactions is going back up, which means that people are starting to reorder? Or is it more driven by the average transaction size, which means that people are basically ordering larger orders instead of more number of people who are ordering?
Sorry, I didn't get her name.
Ankita.
Thank you for the question, Ankita. If you look at those numbers, first let me give you the reality, right? So while close to 80-90% of our restaurants were open for delivery in this last quarter that you're looking the slide at, majority of the stores were either not open for dine-in or open to limited hours on dine. So the recovery on dine-in is being constricted by the fact that the restaurants are not open to people, right? Because of the COVID regulations, state by state, city by city, and so forth, right? But delivery was much more open, so delivery kind of recovered much faster. In fact, recovered over what we were doing in the past years. Now, as things open up, this is going to level out. Earlier Prashant was saying that 55% of our portfolio is in malls. Once the malls open up and the movies release and people get out to shopping, these experiences are dine-in experiences, right? These are experiences where people will be in the restaurant, they will eat in the restaurant, and those will be dine-in sales. And similarly, you have restaurants on highways wherein people are going and traveling, and they will have those experiences in dine-in in those restaurants on the freeways. So you will find the recovery of our dine-in sales as things open up, coming in and catching up with the previous years, F20 and previous to that, and then hopefully surpassing that, right? As far as, the future, if you look at, the next 5 years, 10 years, post-COVID years, as where your question is coming from, I think this is going to very well land somewhere where it used to be in the past. There might be a slight skewed, and that's why we as a company have prepared, put in our own app in place, in addition to continuing to grow with our aggregators as well. So that machinery is already in place, and we will continue to kind of service our consumers, our guests, through that, channel of business. But as we, open up, I think a lot of the sales, just inherent because of the way we are positioned in malls as well as on freeways and even in high streets, that these businesses, whether you're taking a break, for lunch from your office, coming down, getting out of the office and taking a quick bite, all these things will continue to happen, post-COVID. I don't think there is going to be a dramatic shift in consumer habits in the long run because of COVID. I think there might be small, changes for the interim period, which would be the graduating years before we reach complete full open up or full, extension of our business. But that will be interim, and we are fully, as a company with our app, with our aggregators, fully, plan to do this. Your last piece was on the check, which is your question was whether the check was driven because more people were ordering. Yes, some of that is potentially possible, wherein, you have people ordering food and because of the lockdown, both the parents are in the house and they're ordering, and once they go to work, they will be ordering in a smaller amount because they're now split between two different workplaces versus being together at home. So that you might see some of that, but you will see traffic increase dramatically at that point. And the ADS won't be affected, will actually grow in my view. And one of the big things that we have seen during this COVID is a lot of shift from the casual mom and pops to these chained outlets because of the behavior of the consumer that wants to make sure that what they're eating in is sanitary and that they have a good idea which brands are behind that. So we've seen that shift already, and I think we'll continue to see that. I hope I've answered all 3 or 4 questions you had in there.
Yeah, no, that's helpful. Thanks. That's all for me.
Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. Just one question pertaining to your BK Cafe. So you would have built institutional intelligence on the learning curve of cafe extension by other QSR chains, both locally and globally. So just wanted to understand from that, does it add on incremental ticket size alone in terms of throughput, or is it margin and ROC accretive as well? That's first question. And then second, a follow-up on that is, how much alteration does it require on the back end in terms of RM sourcing, talent pool integration from training perspective?
Yeah, very, very nice questions. Very good questions. I was outlining earlier, and I'll reinstate that remark again so that you can reflect on it. If you look at this business, the reason that more and more people are looking into getting into the cafe as part of their already existing offering is it's very complementary business. It not only strengthens, what is in traditionally, if you look at the business over here in India for breakfast is much smaller than the business of breakfast outside of India for most brands. So what it does is it actually, takes that business and makes it stronger for the restaurant. But then it also addresses these businesses between lunch and dinner day parts, which we call as snacking, pre-dinner snacking, post-dinner snacking, or pre-lunch snacking. And it really strengthens that business. It provides, opportunities for people to come in and, actually instead of having a full lunch, but actually just have a pastry or a coffee, brings frequency of use of the brand significantly high. So when frequency of use of the brand goes up, then, reflecting on that, you will see that more and more menu items are discovered, more and more menu items are purchased, different day parts are, used up in the restaurant. So you will find synergies coming together once this cafe brings in, and it brings in more traffic in because it fills in these day parts that were not being filled in earlier because the cafe experience was not there. So you will see a traffic increase. It actually, you pay rent for the entire day, right? You pay a rent for the time you're open, and for the time you're closed, and for time you're not doing business, and time you're doing business. So what this does is it actually makes your business and your traffic into your restaurant more uniform. So you start leveraging and doing more business during those which you would call them as valleys.
So Ramesh, if I can add to what Raj mentioned. So, if we are successful in our cafe strategy, it will drive incremental ADS. It will drive incremental gross margin because cafes are fundamentally higher gross margin as a product. And because our incremental capex that I was mentioning is very low, the ROIs on this are massive. From a Burger King restaurant business which has a between 5 and 6 year payback, cafes probably will have a 3 to 6 month kind of a payback scenario. So across the board, it's a great business to kind of be in. Yes, we will have to go and compete in the market, prove ourselves, and that's the effort that all of us are together trying to put in.
Sure. And if you can comment on the second part of the question on alteration required in the menu and the talent pool constraint, if any.
Yeah, so the menu, is a very cafe menu. You will not find as many food items like wraps and such because we already sell them, right? So you're not. So we build a very strong beverage menu, which is part of this, and a good strong dessert menu. But like other cafes that are standalone cafes, we don't need to deviate a lot from our existing food menu that we already serve, which includes wraps, it includes burgers and such. So it will be mostly focused on dessert kind of experiences as well as a very strong beverage menu. From training point of view, cafes, are staffed with potentially very, fraction of what we do in our real business. So we are taking our employees that are already, working and running our restaurants, and we are training them through the people that we have already hired that are experts. Earlier on, we were talking about Felix, who works with Kapil very closely, who's a award-winning barista. He's putting a small training team together, but our employees that will run these cafes will be part of our employee force that's already there in the restaurants.
Fair enough. A very detailed answer. Just one follow-up on that. So if I see the breakfast side of the demand, and if we see even packaged food industry has not been able to crack it in India because breakfast is something which I believe traditional Indians take very personally, and in terms of we don't deviate much. So do you believe that with no alteration in the menu, we'll be able to cater to demand which is very rigid in some form versus rest of the day menu that is very flexible?
Yeah. So breakfast, it is specific with where the location is. For example, breakfast will become very strong in highway restaurants as people leave cities earlier and they get out of the city and then have breakfast at one of our locations before heading on the rest of their journey. Those restaurants are designed not only with drive-throughs to allow that, but also with larger washrooms for people to get off their cars and get a good experience of having breakfast. So breakfast, in my view, I think we have seen in other global markets when you start actually putting effort. There's been markets that I've run in the past where breakfast was 4 or 5%, and when we put focus on it and start developing it up, it moved to 10% and 15% and even 20%. So it is a day part that is available. Just a focus and some time period of emphasis on continuing to provide good service during those day parts will continue to build that business. It does take time to build that business, but surely that business is there.
Just to add to what Raj said, this is Kapil. We already have egg as a part of our portfolio, our menu, which will play a big role in developing this breakfast menu.
Thank you, Mr. Shah. May we request that you return to the question queue for follow-up questions. The next question is from the line of Jay Kumar Doshi from Kotak. Please go ahead.
Hi, good afternoon, and thanks for the opportunity. I joined late, so in case if my question has already been answered, you can let me know and I'll go back and revisit the transcript. I just want to understand, if you can share some more data or give us some color on how Stunner menu is helping acquire new customers. And, you've expanded the Whopper range, with the launch of Junior Whopper. So how is it helping premiumization? Because I think there is a significant marketing as well as sort of innovation at both the ends to drive customer acquisition as well as premiumization. If you can share some more color on how it has helped you with some data points.
So, hi, this is Kapil. I'll take this question. Let me start with the Whopper first. We did a campaign on the Whopper, in December, January, and we repeated that with another sort of tag-along trial offer. And we shared with you in the last call that the Whopper awareness has grown up to almost 55%. And today, 1 in every 3 customers, as I shared in the presentation, is trying a Whopper, right? Within that Whopper portfolio, almost 20% of sale is coming from the Whopper limited time variants, which are premium priced above the Whopper, right? So that's an exercise that we started in December of last year, increasing awareness around Whopper, the quality, the layers in the product, the taste experience that you get, coupled with the trial offer and continuous focus on building that portfolio. We've come to this stage where almost 1 in every 3 customer tries the Whopper, right? So that's the exercise on the Whopper and building the premium end on the menu. On the Stunner, it's early days. We've been on air until literally last week. We've seen tremendous response on the products. Today we are selling a significant part of our value menu through the Stunner menu. I think this menu will settle down. It's just coming off a campaign. Give us a couple of more sort of months to report on the progress on the menu. But so far we're seeing good traction from the customers and a good share of sales on the Stunner menu as a part of our value layer.
Do you at any point of time?
Sorry, Jay, one just for everybody who's listening here, product-wise details is just one thing that we generally at Burger King don't share on investor calls from a competitive dynamics perspective, and which is where we'll only be able to give you anecdotal color on questions on those lines. Just wanted to kind of bring that out.
That's helpful. On Stunner, a quick follow-up. Do you think that are you in position to track whether it is helping in customer acquisition or whether it is whether it also if the product is too good and the price point is very attractive, it can also drive some down trading. And so how do you track that? And
yeah. So we have 3 pieces. We've shared this strategy which Kapil mentioned last time, the barbell strategy. So we have something called as the value layer, then we have value plus, and then we have premium. Anything up to 50 is value, 51 to 100 is value plus, and above 100 is premium. Yeah, this is something that we kind of keep track on almost on a daily basis, and there will be enough evidence to suggest what a Stunner is doing. 2 challenges. One challenge what Kapil mentioned, too early in the day to kind of comment on where you are coming from. 2, even when we have the data, this is, as I said, so much of competitive dynamics involved in this. So how much we will be able to share is something we will probably think through and probably come back to you next quarter. But yes, this is something that we track almost on a daily basis.
I can add a little bit of color there to what Prashant said, this Kapil, that what we've seen traction on the Stunner menu is that we haven't seen, to your point on the check decline, we haven't seen a dramatic check decline on Stunner. We actually been able to maintain very healthy check. The point is that these 50 and 70 rupee menu items, one is the customer is coming in and trying them on their own in a meal or in a group size of 2 to 3. The other is these are getting added on as trial items or incremental products in the current basket, right? So it's working both ways, and we haven't seen a dramatic check decline on these Stunner orders.
That's very helpful. Thank you so much.
Thanks, Jay.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Thank you everybody for taking the time and joining this call. I know a lot of you have questions on our same store and the fact that we are conservative, but believe me guys, we will come back to you as and when we will revise this. We will continue to share data with you which we think will help you understand our business better, and look forward to interacting with all of you guys with our second quarter conference call. Thank you so much guys.
Thank you. Ladies and gentlemen, on behalf of Edelweiss Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.